In this video, we will learn how to calculate personal income and personal disposable income. First, let us see what is personal income. Personal income is the earned income and transfer income received by the households. Within the country and outside. Okay, so personal income is earned income and transfer income received by the households within the country and outside. Private income is earned income and transfer income received by the households and firms. Okay, so private income is a broader concept than personal income. So in this we are going to calculate only the income received by the households within the country and outside. So these are some steps that we need to follow to calculate personal income from national income. First of all, you have to subtract undistributed profit. This is undistributed profit, which I told you is nothing but the retained earnings or the accumulated profit of the firms. Then also subtract corporate tax. This is received by government. Okay, this is the income of government. So you have to deduct corporate tax from national income. You have to deduct net interest payment made by households. If the households have to make any interest payment to the firm or to the government, then that net interest payment by household has to be subtracted. Maybe they are receiving also some interest. So interest paid minus interest received. And then last step is to add the transfer payment made to the household, transfer payment received by the household. Okay, and this is going to give you personal income, that is the part of national income received by household. Now from this income also they have to make some payments. Okay, so when we deduct those payments from this income, we get personal disposable income. So once we calculate the personal income, from this you have to subtract the personal tax. For example, if any income tax is to be paid by the household, subtract the personal tax from this, or subtract the non-tax payment like fines or something which is to be made to the government. So subtract the tax payment and the non-tax payment from the personal income, and that is going to give you personal disposable income. Okay, this is the income in hand of the households. This is the income which they will use to consume or save, for consumption or for saving. Okay, now we will solve one numerical based on personal disposable income. This numerical is from your NCERT book. See, in a single day, Raju the barber collects rupees 500 from haircuts. Over this day, his equipment depreciates in value by 50. Of the remaining rupees 450, Raju pays sales tax worth rupees 30, takes home rupees 200 and retains 220 for future use. He further pays rupees 20 as income tax. Find out Raju's contribution to GDP, NNPMP, NNPFC, PI and PDI. Okay, first of all we will write down what all is given to us. Okay, see, in a single day, Raju the barber collects rupees 500 from haircuts. His total earning is rupees 500. That means we are given GDP MP. GDP MP is the total money which he is making. So this is GDP MP is rupees 500. Okay. Over this day, his equipment depreciates in value by rupees 50. Then we are given depreciation, that is rupees 50. Okay, then we are given of the remaining rupees 450, Raju pays sales tax rupees 30. Okay, then takes home rupees 200 and retains 220 for future use. Retained earning is rupees 220. He further pays rupees 20 as income tax. And we are also given income tax, which is rupees 20. We have to find out GDP, NNPMP, NNPFC, PI and PDI. GDPMP we have already got. This is the total earning of Raju. This is his GDPMP. From GDPMP we can easily calculate NNPMP. NNPMP. NNPMP will be GDPMP. You have to change G to N. Subtract depreciation. You have to change domestic product to national product. Add net factor income from abroad. There is no net factor income from abroad, so we will ignore this. So GDPMP is 500 and depreciation is 50. So our NNPMP will be rupees 450. This is our NNPMP. This is the second solution, NNPMP. Now we will calculate NNPFC. NNPFC easily from NNPMP. NNPMP minus net indirect tax. Sales tax is an indirect tax. Income tax is a direct tax. Okay, so our indirect tax is rupees 30. 450 we've calculated in NPMP. Indirect tax is 30. So our NPFC is rupees 420. Okay, now we will calculate. So we got the third solution as well. Now we will calculate fourth one, that is personal income. Personal income is NNPFC minus undistributed profit minus corporate tax minus net interest payment by household plus transfer income. Okay, NNPFC is rupees 420. We have undistributed profit in the form of retained earnings, so subtract retained earning from this 220. We don't have any other thing available, so this is going to be rupees 200. 200 is his personal income, and his personal disposable income is personal income minus tax payment minus non-tax payment. Personal income is 200. Tax that he has to pay is rupees 20. So his personal disposable income is rupees 180. This is the personal disposable income of Raju. So these are the 5 solutions that we've got.